Hello friends, if you are married and receiving Social Security, or if you are approaching the age where you will be making Social Security decisions as a couple, I need to walk you through something that most couples find out too late. Social Security is not two separate decisions. When one spouse files, it affects the other. When one spouse chooses the wrong age, it can permanently reduce what the other receives, not just for a few years, but for the rest of both your lives. And the SSA does not call you before you file to warn you that the decision you are about to make is going to cost you $800 or $1,200 a month for the next 20 years. I went through federal SSA rules, 2026 benefit schedules, and everything I could find on how couples lose money they already earned, and today I am going through 5 specific mistakes that married couples make when claiming Social Security. 5 decisions that once made cannot be undone. A recent analysis found that only 9% of new retirees wait until age 70 to claim. The gap between claiming at 62 versus waiting until 70 can run to more than $22,000 per year. Over 20 years, that is $440,000, and for married couples, the stakes compound across 2 people. Stay with me through mistake number 5 because that one is the most overlooked and the most consequential for whichever spouse lives longer. Before we get into it, please subscribe right now and turn on the bell. Social Security rules, income limits, benefit formulas, spousal rules change every year. When they change, the SSA sends a form letter with small print. This channel translates those changes before the deadlines hit. The people who are subscribed find out in time. The ones who are not tend to find out after they have already filed. Hit subscribe, turn on the bell, and let's get into it. Mistake number 1 is both spouses claiming early without understanding that the lower earning spouse's reduction is permanent and different from what they expected. Here is the rule. When a lower earning spouse applies for Social Security, the SSA looks at 2 numbers, that spouse's own earned benefit and the spousal benefit, which can be up to 50% of the higher earner's primary insurance amount, the benefit the higher earner would receive at full retirement age. Social Security pays the higher of the 2. But here is where the permanent damage happens. If the lower earning spouse claims early before their own full retirement age of 67, both their own earned benefit and the spousal portion are permanently reduced. Claiming a spousal benefit at age 62 instead of waiting until full retirement age can reduce that benefit by as much as 35%. Not temporarily, not until they turn 67, for the rest of their life. Here is what that looks like in real numbers. Say the higher earner has a primary insurance amount of $3,000 a month. 50% of that is $1,500, the maximum spousal benefit at full retirement age. If the lower earning spouse claims at 62 instead, they do not receive $1,500 a month. They receive roughly $975 a month, a reduction of $525 every single month permanently. That is $6,300 a year. Over a 20-year retirement, that is $126,000. And that is before we factor in what happens when the higher earner passes away. The survivor benefit a widowed spouse collects is based on what the deceased was actually receiving, not on some theoretical maximum. So the permanent reduction that started when the lower earning spouse filed early follows the household for decades. The one step. Before either spouse files, call SSA at 1-800-772-1213 and ask what the spousal benefit amount would be at full retirement age versus at 62. Get both numbers through your My Social Security account at SSA.gov and compare them before you sign anything. Mistake number 2 is both spouses filing at the same time at the same age without coordinating based on who earned more. Most couples think about Social Security as 2 separate clocks that run at the same time. Both spouses turn 62 or both turn 67 and they both file. That feels fair and simple, but it is one of the most expensive ways to handle Social Security as a couple. Here's the problem. The lower earning spouse's benefit does not grow past full retirement age by waiting. The spousal benefit maxes out at 67. There is no advantage to the lower earning spouse delaying past their full retirement age. The higher earning spouse's benefit, however, grows by 8% per year between full retirement age and age 70, a guaranteed return the federal government backs. That means every year the higher earner waits past 67, their personal benefit goes up by 8%. A benefit of $2,000 at 67 becomes $2,480 at 70. That 24% increase is permanent. It is adjusted for inflation every year, and it becomes the survivor benefit if that spouse dies first. Here is what coordinated claiming looks like. A higher earner has a primary insurance amount of $3,000 a month. The lower earning spouse has a primary insurance amount of $1,200. The lower earning spouse files at 67 for the maximum spousal benefit of $1,500. The higher earner waits until 70 and receives $3,720 a month. Household total, $5,220. If both had filed at 67, the total would have been $4,200. The coordinated approach adds more than $1,000 a month, $12,000 a year, permanently just from timing the decisions together. The one step: log into SSA.gov and look at your My Social Security statement. Find your primary insurance amount, not your projected benefit at 62 or 62, your full retirement age benefit. Do the same for your spouse. Then map out what the household total looks like under different combinations of claiming ages before either of you files. Mistake number 3 is not understanding the earnings test and losing money every month without knowing it is going to be withheld. Here is the rule. If you collect Social Security before reaching your full retirement age of 67 and you continue to work, the SSA applies what is called an earnings test. In 2026, the annual earnings limit for anyone collecting before full retirement age is $24,480. For every $2 you earn above that threshold, the SSA withholds $1 in Social Security benefits. At $65,160, the higher limit that applies in the year you actually reach full retirement age, the ratio improves to $1 withheld for every $3 earned. Here is what catches couples off guard. The SSA typically withholds this money by stopping entire monthly payments at the start of the year until the withheld amount is recovered. A spouse earning $34,000 in 2026, $9,520 over the limit, would have roughly $5,000 withheld, meaning about 2.5 months of checks simply do not arrive. Most people call SSA convinced there has been a mistake. There has not been a mistake. It was always going to happen. The withheld money is not lost permanently. Once you reach full retirement age, SSA recalculates your benefit upward to credit you for the months withheld. But the recovery typically takes 12 to 15 years, and the cash flow disruption in the meantime can be significant for a household that was counting on that monthly payment. The one step here: if you or your spouse plan to continue working after filing for Social Security, go to SSA.gov and use the earnings test calculator to see exactly how much would be withheld based on your expected earnings. If the withholding would be significant, seriously evaluate delaying the claim until you reach full retirement age or until you stop working, whichever comes first. Mistake number 4 is the deemed filing trap, trying to collect a spousal benefit first and delay your own benefit to earn delayed retirement credits. That strategy was eliminated for most people in 2016, and couples who attempt it today get both benefits applied simultaneously whether they intended that or not. Before 2016, there was a strategy called restricted application. A spouse could file for spousal benefits only, collect those while their own earned benefit kept growing, and then switch to their own larger benefit later. Congress eliminated this for anyone born after January 1, 1954. Every person currently approaching retirement age at 67 is subject to this rule. Here is what deemed filing means in practice. The moment you apply for Social Security, you are automatically deemed to be applying for every benefit you currently qualify for, your own retirement benefit and any spousal benefit. Social Security pays you the higher of the two amounts. You cannot choose to receive only the spousal portion and let your own benefit keep growing. The choice is made for you by the system. This matters because some couples still walk into the SSA office with a plan that was legal 10 years ago but no longer exists. The lower earning spouse files expecting to collect only spousal benefits while their own benefit grows at 8% per year. Instead, Social Security applies both immediately and pays the higher amount, locking in a benefit the couple did not intend. The one step. Before any filing, both spouses call SSA at 1-800-772-1213 and ask what benefit amount would be paid if you filed today, your own benefit, the spousal amount, and the combined deemed amount. That conversation takes about 20 minutes and is the only way to know what the system will pay before you commit. Mistake number 5 is the one I want to spend the most time on because it is the one that affects whichever spouse outlives the other. And in most marriages, that means it affects the lower earning spouse for potentially 15 or 20 years. Here is the rule. When one spouse dies, the household goes from 2 Social Security checks to 1. The surviving spouse receives whichever is higher, their own benefit or the survivor benefit, which can be up to 100% of what the deceased spouse was actually receiving at death, not 100% of what the deceased spouse could have received, what they were actually receiving. This is the critical connection to every other mistake in this video. If the higher earning spouse claimed at 62 and locked in a 30% permanent reduction, the survivor benefit the widowed spouse receives is also permanently reduced by that same amount. If the higher earner claimed at 67 instead of 70, the survivor benefit is 24% smaller than it would have been if they had waited. Every reduction the higher earner took in their own lifetime is inherited by the surviving spouse and followed them for the rest of their life. Here's what this looks like with numbers. A higher earner with a primary insurance amount of $3,000 a month claims at 67. Their monthly benefit is $3,000. If they had waited until 70, it would have been $3,720. When that spouse dies, the surviving spouse steps up to $3,000 a month, not $3,720. That $720 gap follows the survivor every month for the rest of their life. Over 15 years, that is $129,600, all from one timing decision. Most households where one spouse significantly out-earned the other will face a meaningful income drop when the higher earner passes away. The one variable they can control before that happens is the higher earner's claiming age. Waiting until 70 to maximize the survivor benefit is often the single most financially impactful decision a couple can make together. The one step, log into SSA.gov, find your primary insurance amount, then ask yourself, if my spouse has to live on one Social Security check for 15 or 20 years after I am gone, do I want that check to be my full retirement age amount or my age 70 amount? That question should drive the higher earner's claiming decision more than almost anything else. So let's bring it all together. Mistake number 1, the lower earning spouse claiming early. A spousal benefit claimed at 62. Instead of 67 is permanently reduced by up to 35%, $6,300 a year or more for life. Wait until full retirement age. Mistake number 2, both spouses filing at the same time. Coordinating claiming ages so the higher earner waits to 70 can add more than $1,000 a month to the household total. Map out the scenarios at SSA.gov before either spouse files. Mistake number 3, the earnings test. Working while collecting before full retirement age triggers a withholding of $1 for every $2 earned above $24,480 in 2026. Know the limit before you file. Mistake number 4, the deemed filing trap. Restricted application was eliminated for anyone born after January 1, 1954. Both benefits are applied simultaneously. Mistake number 5, the higher earner claiming too early. Every reduction the higher earner locks in is inherited by the surviving spouse for life. The highest impact decision a couple can make is having the higher earner delay to 70 to maximize the survivor benefit. None of these mistakes are obvious until the mechanism is explained. The system does not warn you before you file. It processes your application and stays quiet about what you would have received if you had waited. Subscribe and share this with someone you know who is married and approaching retirement. a parent, a sibling, a neighbor, a friend who is about to make these decisions, and I'll see you in the next one.